Okay guys, so we just got done shooting one of my most favorite shows of the entire year. This show's concept was based on a Think Advisor article that said $650 billion is left on the table due to tax savings or potential tax savings for retirees. And there's a lot of reasons why so much money is left on the table. I think one of the most prominent reasons is, first, there's 12,000 people retiring every single day. That's just a massive amount of people who are retiring. And most of those people have the majority of their retirement savings in monies accounts that has never been taxed before. Also, this is the first time that they have been retiring. Think about it when you're 30 or you were 40 years old. What were the types of strategies from a financial standpoint? What were some of the strategies that you were most thinking about? You were thinking about contributions to your employer-sponsored plan. You were thinking about do you contribute to a pre-tax or maybe a post-tax? How much should you be contributing? How much can you afford to contribute and still live the lifestyle you want to? All that was the stuff you were thinking about. You were not thinking really in depth about a time frame where you retired, your W-2 income went away, and your lifestyle was then almost completely, or in some cases completely dependent upon income that you're taking out of your retirement savings, again, which has predominantly never been taxed before. So there's a whole lot of hurdles that people have to overcome who are retiring for the first time. And you only get one shot to retire right. So $650 billion that could be potentially left on the table, that is each and every year. So one of the ways to overcome that or put some more of that money back into your pocket is focus on more than just the investments. It is really tempting for you. It is really tempting for advisors to focus on investments because that's the sexy part, right? That's how you see your accounts go up. That's how you can see your accounts go down in the bad times in the market. So that's what everybody wants to focus on, but then that is how the $650 billion gets left on the table annually. So other things that you can focus on in addition to your investments is one, let's have a tax plan. Let's have a tax plan that is customized based on what you're trying to accomplish in retirement, what your lifestyle looks like, based on the amount of money you need on a monthly or annual basis to have the lifestyle that you want to. And let's focus on the type of accounts that you're going to be taking this money from, even at point of retirement and long-term down the road in retirement. A tax plan can look at a number of different things. One, a Roth conversion strategy. And by the way, this is a simple strategy all in itself. Simply, a Roth conversion is you take money from a pre-tax IRA. It's never been taxed before. You shift it over to a Roth IRA. In the year that you make that shift, you will be paying taxes on that IRA money that you moved over. So you have to be very careful with that. And you want to take advantage of the tax rates that you have available to you if it is a good deal. Clint did an excellent job in the show, giving you a primary example of how a couple maximized their 12% rate, which was a really good deal for them. And what that did is it allowed them to pay money on a conversion at 12% as opposed to doing nothing and waiting, not doing the Roth conversion, and at RMD time, required minimum distribution time, in that case, 75, they took it out and they had to pay over 20% on that distribution. 12, in my book, is way better than over 20%. Primary example, check Clint's example out in the show. But a Roth conversion can be a really powerful strategy if it's right for you, but you have to be careful. You have to make sure it is a good deal for you, short-term and long-term, before you engage in that type of strategy. Another emphasis or another area of focus from a tax planning standpoint does commingle with your investment strategy. The investment strategies that are most common, the investment vehicles that are most commonly used are mutual funds, which again, at 40 years old, you have a 401k at your employer. Most of the time, those employers are only going to offer mutual funds. So you are accustomed and comfortable to investing in mutual funds. Most advisors, they grow up in the industry. Their mentors have always used mutual funds. So that's what they're teaching advisors, and advisors become very comfortable using mutual funds. However, things change. Things change over time, and over the last 20 years, there's been a huge change within the investment industry where it may no longer be in your favor to use mutual funds, and one of the big reasons is because of tax inefficiencies. There's way more efficient alternatives that you can use, like ETFs, exchange traded funds. All you have to do is Google tax inefficiencies of mutual funds. I did this morning. There's 3.4 million articles that talk about this particular subject. Investigate it yourself. There's a study that was conducted that said, on average, annually, with the tax losses in mutual funds, you could save, if you negate those, 1 to 1.5% of return just by negating the tax inefficiencies of mutual funds. Now, this does not apply to your 401k, does not apply to your IRA because that's tax deferred or tax free. However, if you have an individual account, a joint account, a brokerage account, where you have mutual funds underneath of those where you pay taxes each year on realized capital gains and dividends, those types of accounts, if you don't use mutual funds and use more tax efficient investment vehicles, that can be a huge savings to you, especially when we project out that account over a 20 to 25 year time horizon. So we have the income plan, we have the tax plan, and we have the investment plan. We talked about in the show this strategy that is most often overlooked. It's called the cash to income strategy. And this strategy for the last 15 years at least has never been more effective. And one of the reasons is because tax rates are on sale. The cash to income strategy is where you're using cash, you accumulate cash so you can use it for income. And some people will use it for 100% of their income for the first couple years in retirement. And what that does is the cash is not taxed. So the cash has already been taxed. You use it for income, which means your taxable income is very low to nothing. It gives you a whole lot of room to do other tax planning strategies like Roth conversions, or what some people are doing is they're taking their Social Security, they're living on cash and Social Security, which means their Social Security income is not taxed because your Social Security income, whether or not it's taxed, is dependent upon what your taxable income is. You take cash, you take Social Security, you have no state tax on your Social Security in most states, and then you don't have any federal tax. Largely tax-free income. There's other people that retire prior to Medicare age 65. So if you retire at 62, you take your Social Security, you live on cash, that means that you might qualify for the Affordable Care Act, which means you could pay very little or even nothing for your health care costs, because the Affordable Care Act is based on your income, your taxable income, not on the assets. So there are multimillionaires in this country today who are paying very little to nothing for health care because it's based on taxable income, and they've created an income stream that has very little to no taxable income. That is a strategy that you can employ, but this is something you have to plan for, especially if you don't have a lot of excess cash on hand now. But if you put your plan together years before you retire, these are strategies that you can identify, build up some cash along the way, and then use that cash as a supplement to income, decrease your taxable income, or as the entirety of your income, really decrease your income, which gives you a whole lot more room to incorporate healthcare strategies, even decrease taxes on your overall Social Security. We talked about one other element within the show, and this was based on the question. So we get questions from our online Journey to Retirement workshop. And some of those questions, we just get a lot of questions. We can't answer them all in the workshop. So we take a few and we answer them during the show. This question for today's show was, I have an old annuity. What do I do with it? And there's a few things that we need to look at with this. And there's a whole bunch of you in this situation who have either an old annuity or you are currently being sold an annuity. You're evaluating whether or not you should use an annuity. Here's some of the things that you should consider. One, and most importantly, is how is that annuity going to work within your plan? What benefit is it going to provide you? Are you going to take income from the annuity? Is it designed to keep your principal safe? Is it designed for safe growth? there's all these different considerations and things that an annuity can do for you that need to be evaluated. There's a lot of fees that can be tied up with annuities, hidden fees, transparent fees, evaluate what kind of fees are associated with the annuity, and then determine, does it make sense for you? With interest rates high like they are today, there are a lot of people who got locked into an annuity 6 years ago, even 10 years ago when interest rates were near zero. So the return potential on that old annuity isn't nearly as great as what the newer annuities are offering in some landscapes today. So that is also a part of your overall evaluation. But the annuity or any type of investment that you consider, what you need to do first is build your plan. So if you haven't built a plan yet, you have investments, kind of the junk drawer type of investments where you've accumulated a lot of different investments over the years, you're just not sure how to use it in this new phase of your life, or you're looking at replacing some products like mutual funds or annuities, just push pause, don't make any rash decisions on those products, and build out your plan. Because the plan will lead you to what types of products are appropriate for you, what kind of money should you have in those products, and what kind of overall risk you should be taking, which will lead to what kind of investment diversification is appropriate for you to accomplish your overall goals. So don't make rash decisions, push pause, create a plan. That will lead you the way. Check out the episode. There's a whole lot more within the episode. And if you have questions on any of this content, because there was a lot, take advantage of the Retire Ready Call. Very simple. All you have to do is go to retirereadycall.com. That will take you to a place where you can sign up for a conversation with a retirement planner to go through all the specifics with you that are really important to you to helping you on your way to and through retirement.